So the ESLR reduction, what does it actually mean? So in the post-global financial crisis world, we've had the Bank of International Settlements, which is the central bank for central banks that really operates as the trusted third party counterparty man in the middle for international trade, just processing cross-border transactions. They all run through the BIS, which is domiciled in Switzerland. It's a private foreign bank as well, important to keep in consideration. The GSIB rules were basically kind of passed down as part of the new regulatory frameworks, and basically there's this rule or this kind of agreement that's been placed to comply with Basel III and other post GFC regulation meant to ensure that we don't have another 2008 financial crisis. Required the GSIBs to hold a, a significant amount of capital behind their loans or their credit origination. So if you think about a bank's balance sheet, this is where the money creation actually takes place inside the commercial banking system. When a bank originates a loan or funds a debt security like a U.S. Treasury, they have to hold some equity capital against it. And what the ESLR, the enhanced SLR, requirement was, it was basically an extra surcharge on top of the GSIBs, globally systemically important banks, replace the what was the old acronym, SIFI or something, systemically important financial institution, just a new four-letter acronym. But basically, like you can think about it as like a G7, G8 country, kind of has its qualifying, large commercial banks that have to comply with these rules in order to be in the good graces of this key middleman who operates as like a key hub and spoke in the cross-border financial transactions, right? So what the E in enhanced SLR is an extra surcharge that your GSIBs had to hold in reserve in terms of equity against just new credit creation, right? So for US GSIBs prior to Tuesday's announcement, where we had Michelle Bowman from the Fed announce the ESLR was being ratcheted down from 3% extra capital surcharge down to 1%. That's on top of like a 3% tier one equity requirement that operates pretty much across the board for the SLR part, the supplementary leverage ratio. And what the E was that extra 3% is effectively lowered to 1, so that now if one of our GSIBs, and I think the US has 5 of them, it's your JP Morgan, Wells Fargo, Citibank, et cetera, your largest, it's what we all kind of categorized as too big to fail institutions, right, after 2008. Now, when they buy, say, a Treasury and fund the government or the public deficits, right, and that increase in national debt, now instead of holding $6 in capital behind that $100 of credit created or extended to the federal government, now they only need $4. So in effect, it's a 2-point reduction on 6, so it's a 33% reduction. And the amount of capital required to fund that, that same equivalent $100 of Treasury debt. Now, in terms of capacity in the system, like where the rubber meets the road, what the important thing is, once we lower this from 3 to 1, what it frees up is bank balance sheet capacity, like of our big 5 GSIBs. So what this allows them to do is fund more of the Treasury debt issuance inside of the domestic U.S. financial system. And what that means is for the same, public deficit curve, like just take that as given for what it is, right? We have the CBO models. We've been through this process, big, beautiful bill, all of that. All of that deficit spending is essentially planned for. What this actually impacts is what percentage or what share of those dollar IOUs are going to be funded by the onshore banking system, which the U.S. government and public sector has regulation over, and which portion is going to go cross-border or offshore, right? So this plays into the broader story you've heard Cameron and I, talk about over the last 52 weeks of 2025 and beyond, of what's going on in the global dollar system itself, the reining in of the offshore dollar, and kind of harnessing that in, and putting more domestic coverage on top of the dollar itself, or the domestic system's role in regulating the dollar in terms of international trade, credit expansion, all of the above. So if you get into like nominal values, what does this actually mean? You got a couple of estimates here in terms of what this would do to the theoretical purchasing capacity of the U.S. domestic banking system's ability to show up at these Treasury auctions, weekly, monthly, et cetera, and take down more of the U.S. Treasury debt issuance. Two banks here, ING, this is a Dutch bank, so both of these are offshore. ING estimates that buying capacity after this ESLR reduction to be 4 trillion, and BNP Paribas, French bank, we've talked about them in prior episodes, certain things they've been involved in. Go back, look at, I think it was 3 weeks ago, we talked about the Sudan, Darfur court ruling. That was particularly notable to BNP Paribas. But they estimate in a research report, they put out the number 6 trillion. What this would amount to in terms of incremental excess capital would be $200 billion, so 0.2 trillion. So if you put that to an annualized amount in terms of budget deficits, right? This is percent of GDP. Key thing here is the flatlining of that share of deficits to GDP that we saw with One Big Beautiful Bill, et cetera, in terms of the CBO's planning. The goal is to stabilize that and then to fund more of that that debt issuance domestically. This doesn't solve the problem itself. It does nothing to slow down the public debt growth nominally, right? We just cracked 37 trillion. That number is just going to keep going up for the status quo, short-term, medium-term time frame, right? Those are locked in. It's all what we're working towards is putting a ceiling in terms of those blowout deficits and then funding them domestically. And this comes down to, at the end of the day, which banking system basically has control over the debt IOUs, which ultimately works its way in control of global dollars exchange rate, yield curves, and credit creation itself. So
And just to
all
jump
of,
in here, Matt,
yeah,
so just to make sure I'm following you here, what you're talking about is so on this chart here, total deficit, you're basically saying the goal here is, disregard the light purple versus darker purple for this for now. We're looking at what percentage of that total deficit is attributed then to domestic banks versus offshore banks, and we want to try
yeah,
to tilt that scale more towards the domestic banks. Is that
that
correct?
that's correct, right? So
Got it.
as we're this debt problem is just going to keep bleeding out. Like everybody who thinks we're going to solve this deficit spending problem through some act of Congress, it won't resolve that way. Like we can't rein in spending to control this thing.
Yep.
The fact of the matter is the deficits are going to happen regardless. It's baked into the monetary structure. It has to take place. What we can change is the structural flows. So that's what you see going on with this example this week. Where are the IOUs going to flow? Well, the ESLR reduction on net, all else equal, tilts the playing field from those dollar IOUs and the financial deficits working their way offshore, right? So you get this dollar bleeding
I see.
from the domestic US economy to offshore. And if you think about the other tactical policy approaches that have put in place this year, tariffs are another example of a force working towards the same direction of like compartmentalizing the dollar flows, so you don't have that onshore to offshore leakage that's been taking place for at least 50 years, but really it's the post World War II systemic structuring.
Right.
So with the tariffs, instead of, I mean, the world or the U.S. just bleeding dollars to the world, and you have this buildup of the offshore dollar. With the tariffs, what you have is policy implementation through the international trade channels directly. You put a tariff on the importer. Let's say a good costs $100, right? Everybody going Black Friday shopping today at let's say Costco. You go buy a pair of headphones that cost $100. Prior to the tariffs, the government was taking no charge. The importer would take its price markup, and ultimately, say the consumer is passing or is willing to pay 100. The manufacturer or the exporter, based in Southeast Asia, may get 50, right? And everybody's got to take their cut through the system. Once you have tariffs, and then those dollars, the headphones come in to the U.S., wind up in the consumer's house. They're walking around with the AirPods in, everything. Everybody's doing it. Those dollars flow externally, right? They go from a U.S. bank, and then the ledger transactions, they work their way offshore to, say, a bank in Hong Kong, right? And then it shows up in the Hong Kong dollar, a dollar peg currency. What you get with a tariff now is an extra charge. Let's say it's 100% tariff. Let's say the importer is paying $50 to the manufacturer. Well, the government is now going to take $50, right, to keep it simple. And so, in effect, what happens, the U.S. consumer, this is why we're not seeing blowout inflation on the tariffs. And you saw a Fed research report come out, and I didn't link to this, but it says the tariffs are not inflationary, right? It's research opinion, right? But this gets into it. The consumer of the headphones, right? Let's say your headphone price went up to $200, right? Some of us may be able to absorb that in our budget. We'll have to spend an extra $100 to get our headphones. I know AirPods cost more than that, but let's just be
Make it easier for me, please.
keep it simple.
Yeah.
Yeah. But not everybody can, right? Not everybody's wages go up by that incremental 100. So on net, that's why you don't see the prices of AirPods and everything else imported just blowing out. It's because the American consumer can't afford it. And if the consumption isn't there, there's no export base, and the production just builds up an inventory, and you got to find a new market to export into. All right, so it's tough to find. So what we're seeing is, all right, the U.S. government is going to take the 100% tariff. That what it actually nets out to is the exporter, let's say Southeast Asian in this case, your AirPods are manufactured in Vietnam, they'll get fewer dollars, right? So they're showing up. They're still willing to export into the U.S. consumption market, but on net, what this amounts to is fewer dollars leaving the onshore system. So it's all part of that story we've been talking about. SOFR replacing LIBOR, U.S. Domestic financial system taking control of overnight interest rates and short-term dollar liquidity funding markets. Same thing with tariffs. This is the same thing with the ESLR. Now we're saying, all right, now we're going to be sending fewer treasuries offshore to fund this. And so I'll come back with this. I need to go refresh on Gordon Pepper's money, credit, and asset prices. But what this is actually going to do, or expected to do, if you take that framework, I need to go back, brush up on this, and read it with a new lens. How would this policy map to the Gordon Pepper framework? But what it would be expected to result in, based on my quick assessment this week, you would have the domestic financial position of the U.S. financial system, which you would base it on public debt, less foreign or borrowing from foreign entities. This policy should start kicking that up, so that rises. That domestic financial position of the banks in terms of the public debt standpoint is equivalent, it's an accounting identity to the net deposits in the system or in the domestic U.S. financial system, which would be deposits themselves, time deposits included, held at U.S. bank or U.S. banks, less loans, right? So if the U.S. Domestic financial position, that rise in public debt holdings, essentially monetized through the domestic commercial banking system, increases, you have to see net deposits, like deposits minus loans, come up with that as well. And what that would lead to under this framework, what you would expect is balance sheet expansion within the U.S. banking system, which means more credit, more lending, is how this would work itself out. And then because this policy is like putting the containers, like just hermetically sealing that border, where the
Right.
U.S. sovereign jurisdiction ends, the 50 states and its held and its territories and possessions, you contain that dollar liquidity inside of the U.S. itself, and that doesn't leak offshore. And this is what we saw with prior iterations of stimulus, right? The 2020, trillions of QE plus trillions of fiscal spending with CARES Act, American Recovery Act, CHIPS Act, et cetera. A lot of that dollar credit creation on the public side ultimately just wound up leaking right into the offshore
Because you're
system.
buying
So
those products
so
from offshore, or you're investing over there. Yeah.
yep. So this is what's happening in terms of policy. It's very clear at this point what the U.S. Treasury, the Fed, you could even say the Trump with the tariffs themselves. It's all working in coordination towards this objective of ultimately putting up a barrier between the onshore offshore dollar. Um, this is what we're living through play out. So very interesting things. I'll brush up. I'll read through. I know we're on vacation now. I'm probably not going to do it here, but maybe between Christmas and New Year's, I'll do another reread of Gordon Pepper's Money, Credit, and Asset Prices, because there are implications. He does deal with this from a UK perspective and the pound sterling, what it went through in the post-war, post-World War II environment of its own banking system. I'm gonna read that, brush up, and hopefully give you the audience better crystal ball, if you will, of what to expect from this as the U.S. continues to build out and reinforce this process we're talking about.
And Matt did do, if you want to search through our prior archives, Matt has done an overview of this as well previously. So highly recommend that
Yeah,
before he maps that onto what's going on today.
yeah.
Okay, so let's kind of
We
continue
we
here.
we
Yeah.
talked about it in previous episodes about what it means for public debt markets itself, but there's an additional kind of body to the whole framework on what happens or what are the implications of public deficits being funded and financed through commercial bank balance sheets themselves. And that's clearly the policy we're working towards. Um, I would say the net effect, I would expect it to be inflationary over the longer term, inflationary in its truest definition of commercial banking balance sheet expansion. So continue to watch. We'll give an update within the next few months, but hopefully we'll have something richer to add on that topic. Now, something kind of beating this horse to death, but what does this actually net out to in terms of the balance sheet composition of the U.S. commercial banks themselves, in terms of Treasury holdings? And then the other thing that's important is the top line expansion. Under a fiat credit monetary model, right? You really get GDP growth through balance sheet expansion in your financial system, right? So this is the whole crux of the matter. What you can't have is actually balance sheet contraction. That's a very bad thing for these structures and monetary systems. And what you're looking at with the ESLR reduction would be more treasuries on the commercial bank balance sheet. So I've got that on the top half of this chart here. In red is the U.S. Treasury and agency debt holdings. So when we say agency, it's a government-sponsored enterprise, not including any mortgage-backed securities or any Fannie Freddie real estate lending, any of that. This is just purely Treasury lending, and then you can also include, say a lending or debt directly to a government agency itself. So an arm of the federal government. The reason I have that included here is just because the Fed's H.8 report doesn't break those two things out. You just get the whole thing together. So right now, the U.S. owns 1.9, almost 2 trillion of the federal government debt or its related arms of GSEs. That's on a total balance sheet of about $21 trillion. That itself is a little bit less than nominal GDP, which is about $27 trillion at that last check. So what this would do, this ESLR policy, it allows your 5 GSIBs to own more treasuries. When you increase that bottom number, this is just stroke of the pen, right? Banks can buy 0.2 trillion more treasuries just overnight, let's say. That's going to work its way into the system in the very short term. Your top line of credit in the banking system will also expand with it, right? So your total assets in the banking system goes up as well. That should, create more credit creation, more money supply, right? That's the M2 growth. If you look at the bottom, what are the ratios of these two things? Since about 2020, we've seen, it's clearly an uptrend since at least 2014. For the U.S. banking system as a whole, the composition of these federal government, debt assets held on commercial bank balance sheets, it's risen from about, let's say, a 6% level. It crossed over in 2020, and that number continues to tick up. You see the trend on the chart in terms of the share of the bank's balance sheet that is funding treasuries. It's up to 9.3% right now. And this is where the ESLR doesn't do anything in terms of tilting the playing field towards lower capital requirements for GSIBs for the Treasury debt itself. They're still not quite apples to apples themselves, right? A U.S. Treasury asset is considered lower in the context of the system itself compared to other credit lending. This doesn't do anything to address that gap, but what it does do is just increase those top lines directly, so you can get more balance sheet expansion, more money creation in the domestic financial system itself. The other thing I'd raise here, so Bloomberg doesn't have a good series on this where it splits out the large commercial banks. So it's the top end. You have to cross over a certain balance sheet size to make it into that group. But the large commercial banks actually hold a greater share of their balance sheet in U.S. Treasury and its agency debt by a significant margin versus the regional banks and smaller. So, right here we show the 9.3%. That is heavily skewed towards your GSIBs. Your large commercial banks, based on the H8 reports breakout, they're holding 10.9% of their balance sheets in this line item, the Treasury and agency debt, non-mortgage-backed securities. Essentially, almost 11 cents of every dollar that side of the balance sheet is funding the Treasury deficits, rounded out for the agencies, which are also included in that number. Now, once you get below that fold, look at the banks outside of that large group that the H.8 report classifies and breaks out, it's only about 5.8%. So if you're an American, you're working with a regional bank or your local bank, odds are that those institutions are already by themselves not buying as much of the Treasury's debt issuance. What they're doing is the actual yeoman's work of lending into the real economy. So real estate loans, commercial loans, et cetera. It's about a 2-to-1 gap. So 5.8% of the assets on the balance sheet for a non-large commercial bank in the United States versus 10.9%. So you're already looking at about a 2x. So this doesn't fully resolve that problem. I would say expect for more bank regulation and supervisory um, just updates over the coming months, quarters, years as we continue to work our way through this big picture process. Like this offshore dollar and the public debt, all the monetary structure that led there, it's 70 to 80 years of entropy buildup. It's not going to be solved overnight. It's slow steps and progress, if you will, towards getting through this this problem.
Right.
All right.
It's really interesting to me that it's such a wide disparity between GSIBs versus the regional banks, but it makes sense from a regulatory regime, right? It's easier to then say these top, 10 banks, six banks need to have this different different ratio in their holdings.
Yeah, and they're the safety valve. They're the largest balance sheets. They're the primary dealers. Whatever they can't distribute to their clients, now it's going to just
Stick on the
bottle up
balance
on
sheet.
their balance sheets and
Right.
then work its way out into credit creation in the U.S. economy. And once you have this compartmentalization layered on, and it's not a 0 to 1, it's a sequence of just building up. So that all right, once we do this balance sheet expansion, does the inflation stay within the United States itself? Right, and that's
Right.
that's that's the end goal of this. Now, some other dogs not barking or kind of related headlines. So how do you kind of get your spidey sense that this is going on, or what else are we watching? So mid-October, this was an October 15th report. You got a report and the Fed's Notes series from the just army of PhD economists who work at the Fed and are writing research papers. You got a paper that came out that really highlighted the buildup of those dollar IOUs finding their way to fund the public debt, finding their way to the Caymans, right? They specifically singled this out, for a
I thought it was
reason.
really interesting. Yeah.
Yeah, this is all about the onshore offshore dollar, or this would be a piece of evidence providing credence to that point where Fed policy is directly trying to address and monetary policy, Treasury policy, et cetera. Um, this this defense buildup, if you will, to put the wall in between the onshore offshore dollar. So specifically targeting some charts in the paper. Figure one, they highlight the growth of hedge funds short positions in Treasury futures. So this would be on the CME Treasury futures contract, the short position. This is the basis trade everybody is talking about. You go long the Treasury bond themselves. So this would be your offshore bank um, funding or showing up to the Treasury auction to take down its share of the government's borrowing. They own the Treasury bond outright. They hold the cash bond asset. What do? They turn around, they post it as collateral on the CME, and they short the futures and they engage in this just yield pickup, the spread, the basis trade, right? You can see the blowout here. Hedge fund short positions in Treasury futures. It's well documented in the financial media. Um, it correlates to the growth in the Treasury debt outstanding, but a greater and greater share of it is funded through the levered basis trades. Now, what this research paper pointed out and called attention to is a heavy share of this activity is coming out of the Cayman Islands. Hedge funds domiciled in that jurisdiction. And yeah, it's a strong argument to be made if you look at the breakout, Caymans in red, non-Caymans in blue. Uh, the Treasury securities themselves are being purchased by entities ultimately mapping to that Cayman Islands jurisdiction. And then the repurchase agreements, the short-term lending, or it could be the basis trade itself, where those treasuries are posted as collateral to fund another offsetting position, say repo markets or similar. That's also highly correlated with the Caymans. So the Fed themselves are, um, or the researchers, the papers they're making public are really pointing to the same conclusion about the offshore financing of the U.S. government budget. So really expresses the signal that you're looking for, that what you're seeing with the ESLR, what you're seeing with the other moves, the tariffs, et cetera. It's all about, where does the control of the dollar live? Is it onshore versus offshore? And the trend since, I'd say at least the turning point somewhere between the Yellen to Powell Fed transition over a decade ago at this point. Also, the promotion of John Williams to the New York Fed. I'd say that's probably where we hit the turning point. And this trend is just continuing, right? So this is the battlefront that's emerging in the global capital wars, and we'll continue to watch it as the situation further develops.